much fuckery is going on in which market. But, yeah.
Oh, great. Here's Murphy, right on schedule.
Join you on the comp. All right, give me 2 seconds.
It's like, come on, bud. All righty, we're good to go here. So, I'm gonna.
Oh, great. Here's Murphy, right on schedule.
Of course.
It's like, come on, bud. All righty, we're good to go here. So, I'm gonna let me go open this door here quick. Oh, I'm up there, so you can go outside of the deck.
Let's see here. So basically, last week I was showing people that banks have officially.
Alrighty. So the first thing I really want to talk about is going to be this banks and everything going on here next week.
What do you think?
Let's see here. So basically, last week I was showing people that banks have officially stopped loaning to each other. Once that starts, I feel like that's going to start the domino effect. That's the first sign that we wanted to see. What do you think is going to start happening? Sorry, now that the banks have stopped loaning to each other.
Yeah, I mean, and you got a sense of what could happen. Like, so the precursor to 2008, when Bear Stearns blew up, then sort of in this early 2008. Some of the banks started to question, well, do I want to be doing deals with Lehman? And so you'd start to see people like, to basically say, no more trades with Lehman. And then, so what we saw about a week and a half ago was people saying, at least 4 banks that I know have said, we're not doing any more transactions with Credit Suisse. And so this could be like, at the most obvious, it's like in the repo market, it's like, short-term liquidity, we're just not going to roll any more deals with you guys. And it's like, well, then what do we do? And so when that happens, you're pretty much a target. And like the banks are limiting exposure to each other in the short term because they don't know when the next landmine is going to go off. And with Credit Suisse basically nuking $17 billion worth of bonds, that has repercussions on the entire cocoa market, and then that has implications for the collateral value. So everyone's sitting there going, well, what, this deals are based on collateral, and we don't know if your collateral is good enough anymore. So we're going to cut back our deals. So I haven't looked at the numbers, but I do recall seeing people posting about the jump up in actual Fed repo. So that's an indication. Yeah, people are not trusting each other. They're going to the Fed window instead. And that repo facility didn't exist in 2008, by the way. So it's like, I think, a $500 billion facility. That was created because Lehman event back in 2008. So yeah, we would probably be at a 2008 event already if it wasn't for the fact that they put these speed bumps and these liquidity provisions in. But no matter what they have done, it's still a pretty ugly scenario out there. And you said that we can get into the fact that all these swaps are coming due with a 6 month or 1 year, but the 6 months, I guess, is the more pertinent here. But I can't. I guess you just don't know how bad it is. But yeah,
it's bad. You're over quadrillions in the derivatives, and see, this is the thing. The one thing that people aren't talking about, like you just said, it's not just a liquidity crisis. You got a collateral crisis everywhere.
Yeah, and that's so let's go so we talked in the first space call we did like 6 months ago. We targeted 3 banks that we thought were going to be the first to fail. It was Deutsche Bank, UBS, and Credit Suisse. I mean, we're not talking about the regionals. We're talking about the big boys. So, and we noted it was the CDSs that were sort of telegraphing that. And the funny thing is that I've been looking at Deutsche Bank for years, and as basically the problem child of the banking world. Again, the big banks. And this is a long story, but so my only surprise of what happened recently is that Credit Suisse failed before Deutsche Bank. Deutsche Bank has been basically scaling back operations on the investment side for several years. The current CEO is a commercial banker. He basically has a commercial bank bias, and Deutsche Bank used to be back. In the early 90s and before that, they were a very well-regarded, strong German bank. I mean, it was like, this is German efficiency, German, it was a really well-run bank. And then what happened was it got worse when Clinton administration removed Glass-Steagall restrictions. But basically, you saw a big trend towards bigger is better in U.S. banking. Basically Citibank was buying all kinds of regionals, and Chase and J.P. Morgan merged. So Deutsche Bank is sitting there in Europe saying, we're dominant in Germany, and we're well positioned in Europe, but we want to grow in U.S. And it's like, well, two ways of doing that. You grow organically. You start your subsidiary office in the U.S., and then you try and grow. And some like the Canadian banks have the same problem. Canadian banks dominate Canada, but internationally they're small. So it's like, well, we there's no market share in Canada. We can only grab from each other. We want to grow somewhere else. So they decide, well, we want to go to the U.S. How do we do it? And they've all sort of been slowly picking away at small regional U.S. banks. And so TD bought Ameritrade or whatever, and that's no longer under their control. But like they've been buying regional banks as well. So TD's been going East Coast, West Coast. Royal's been picking here. BMO's got their Chicago Harris Bank, and then CIBC is twiddling around. So the Canadians have to do the same thing. So anyway, the Deutsche Bank in the 90s was sitting here, well, we need to grow. And we're too impatient to grow slowly. And that's kind of weird because, they were a very conservative bank, but they decided, we're going to go all in and we're going to buy a bargain because Bankers Trust, they bought for like $10 billion in 97, 98. This is just as Glass-Steagall is being, unwound anyway. And they paid $10 billion for it. And they thought, this is a bargain. Why? The problem with Bankers Trust was like they were the most toxic. Like if you could stumble into a scandal, Bankers Trust was doing it over and over and again. It's just like Credit Suisse did now. But it's like so Deutsche Bank decided to go and buy the bad boys of Wall Street, which is Bankers Trust, and they basically guaranteed bonuses, and they basically kept all the crappy people that were causing the problems at Bankers Trust. So you have to understand, this Deutsche Bank went from being like one of the best banks in the world to basically being a loose cowboy. And I'll give you an example, just how bad it was. So when I was at 98, I was at the Bank of Canada. My job at the Bank of Canada was to monitor the Canadian bond market, money market, and find out, what was going on with particular issues, and what bonds were hot, what were not, and it was important for us to know this stuff because we were doing our debt operations. So which bonds should we issue more of, and stuff like that. So anyway, we talked to all the bank dealers every day, and had the Canadian banks call in and say, hey, there's a problem with this 2-year bond. It's hard to find, and it's basically squeezing. And as a central bank, you don't like squeezes in bond markets. You want it to be liquid. So we're going around and we're finding out, who's owning this thing? Well, everyone's telling us it's Deutsche Bank. So we talked to Deutsche Bank. Hey, what are you guys doing with this bond? Oh, we're not doing anything. We only have this. So it turns out the Canadian trader at Deutsche Bank, bond trader, was lying to us. And we had to go to his boss in New York. And, but this is just in 1998, just as Bankers Trust was merging with Deutsche. So the culture was already being polluted even within 6 months of the deal happening. And this guy, he had the temerity to lie to the central bank and thinking he wouldn't get caught. I mean, it's ridiculous. He ultimately, the systems weren't that great at the time, but, when every other dealer on the street was turning on him, so it's like you think you can get away because you're smart, but no, you just, anyway. So that was the cowboy mentality. And the worst part about it was 6 months later, I went to TD and I was on their foreign exchange desk, and we were Asian currency crisis and Russia default. We were making crap loads of money on the volatility. And then I find out 6 months later, I was sitting in the trading room, and one day see this expletive deleted from the other side of the trading room. It's like, what the fuck was that? Excuse language. And it was like, that was the new head Canadian bond trader who just got hired from Deutsche Bank, just blew up his book, making a wrong call in the Bank of Canada. So he killed our bonuses. This is the same guy that lied to the Bank of Canada, literally 6 months before he was lying to us. And so now I got this idiot blowing up my profit, my bonus pool. So I have personal issues with Deutsche Bank to begin with. So just that's the context of that. But they, since that merger in 1998, I passed around a story on Twitter this morning. They stumbled into scandal after scandal after scandal. The fines they've paid since 1998 are more than the original purchase price of the firm of $10 billion. So they've just been the bad boy of Wall Street. And again, it's a cultural issue inherited from the Bankers Trust. And it's like, this is as I said, Credit Suisse was a bunch of cowboys. They were emulating Deutsche Bank, and so it's no surprise to me that Deutsche Bank's credit default swaps are are a problem because they've never cleaned up all the crap that they buried in 2008. I mean, who knows what they've been sitting on? And, said they've been revolving it through swaps. And as you point out, these derivative exposures get bigger and bigger and bigger. And probably the most garbage exposures are sitting on Deutsche Bank's books. So, when last week, when the Credit Suisse blew up and the cocoa bonds were a problem, and then people started targeting Deutsche Bank and UBS, CDS were also going up, but Deutsche Banks were already elevated and then kept going up as well. And so, the rumor last week, of course, Deutsche Bank's in trouble, target on Deutsche Bank. And then we have the mystery, Janet Yellen closed door meeting on Friday. And I would dollars to donuts bet that was more about the Deutsche Bank derivative exposure and what it would do to the rest of the banking system than it was anything else.
You don't think it's about the FDIC being maxed out and the debt ceiling?
Well, that's part of it too. I mean, it's like it's all related. But yeah, like the debt ceiling is another issue we can probably get into. But that's I know at least part of the issue. Like I said, it's been very interesting to me that there was a whole bunch of use the playbook. Like my favorite, one of my favorite movies, Die Hard. It's like, oh, they're using the FBI's playbook, and it's predictable. The Fed officials, like in the European banking officials, all saying the same thing. Oh, Deutsche Bank's profitable bank. Oh, everything's under control. Oh, we have, it's like you guys are protesting too much, and this is like the sound bites sound ridiculous because it sounds like you're just pulling out the manual and you're just saying the things that you think you need to say to stabilize the market, but. I mean, we'll see what happens tomorrow. But this whole weekend has been very strange because, last 2 weekends, it's like all kinds of rumors coming out. And this weekend has been radio silence on Deutsche Bank.
Trying to contain it.
Yeah, exactly. So we'll see what happens. But I do think that, part of the concerns on officials will just be what, Credit Suisse blowing up, Swiss National Bank allocated $9 billion for potential bombs. And then, the 17 billion already lost in the cocoa market. But Deutsche Bank, because of all the derivative exposure, just impossible to estimate what the collateral will be. So collateral damage will be all over the place. So I'm very particularly, I don't know what's going to happen. I guess, as I said, if you were looking for a banking black swan event, Deutsche Bank going down would be a major one.
I agree. Definitely, like you said, that's been our third out of the big three. So, I mean, the other two, one of them had to absorb the other one, get bailed out billions. And did you see right after they got bailed out, they ended up paying billions in buybacks on some bonds. Then they ended up paying a whole bunch of fines off that they couldn't afford before the bailout. It's just like one sinking ship bailing out another sinking ship. So it's just a matter of time there. But next thing I wanted to get into was, like you were saying, so Collateral's drying up with phase 6. They're running to the feds, and now they've borrowed $500 billion in 2 weeks. Did you see that they want to raise it now from $2 trillion?
Yeah, I saw that. So yeah, like that. The interesting thing is, I was passing on a graph. James Bianco and others in Wall Street were pushing on the Fed balance sheet graph. It's I think you can just go to the Federal Reserve website and you can get the updated version. But it's like you see the quantitative, tightening that started in July last year. They did actually more progress than I thought. They took it from like whatever 9 trillion down to like 8.4 trillion. Or 8.3, and then in the last 2 weeks, it's back up 600 billion, and it's like, so you're basically, all the progress of 8 months worth of quantitative tightening has been unwound in 2 weeks. So that's like, it's not, don't call it quantitative easing. It's okay, it's not, but it's still, you're adding to the Fed's balance sheet, and you're basically essentially adding liquidity to the banking system. So this banking system liquidity is needed, but yeah, as you said, the bigger issue that none of these liquidity measures, the liquidity measures help in the short term, but the ultimate problem is the collateral is now questionable. And, and the big focus, at least for the regional banks, of course, is even if they were to get full 100% deposit on their deposits, on the, basically have the ability to park their bonds at the Treasury and get 100% backing for the, no collateral haircut. So, okay, liquidity issues, even if they lose deposits, they're not going to go out of business. And all customer deposits are 100% guaranteed for 2 years or whatever they're trying to get. The bigger problem now is the Fed keeps hiking. Loan losses, especially on the commercial real estate books, are thought to be a huge bomb. And so, one of the issues with not Silvergate, Silicon Valley was like, yeah, a lot of their loans were with venture capital firms, and it was questionable whether those were actually going to be repayable anytime soon. So you have questionable the value of your collateral on your loans. Like, are these mortgage real estate loans really worth what you think they are? And that's, again, where you start questioning what the hell, we got this derivative exposure with law and it's backed by this, but do we actually believe that this is worth this now, given this, and the cocoa bonds in Europe blew up, and yeah, like, you look at the commercial real estate market, and everything I've heard for the last few years was like, especially since COVID, it's like, commercial real estate is killing us. There's like empty lots everywhere. There's like stores never recovered, big malls half empty. So yeah, like how these properties aren't generating the revenue they're supposed to be generating because no one's reoccupying the stores. And some of that is things like GameStop. It's like, yeah, we had physical presence and we're trying to reduce that, and we're trying to do a lot more online. So, the GameStop is not an isolated incident. There's a lot of customer, retail firms that are saying, do we really need to have 2,000 stores? Maybe we'll just do 500 stores. And I mean, I can even talk to like things like food courts. Like, I don't know what it's like down there, but in Calgary, there's so many malls where like, they could have 20 food vendors, and they have like 2 or 3 open on the weekends, and half of them are boarded up. It's like that. The commercial real estate is not what it used to be. So if you've taken, issued a 20-year commercial real estate loan, or whatever the hell the term is, it's certainly the last few years, you're not generating the revenue. That property's not generating the revenue to support those loans. So
the mall right next to me, actually, they ended up getting bailed out by the city. Otherwise, they were actually going to close down because of that exact reason. Sorry to cut you off.
No, exactly. That's a great example. That's what I'm talking about. It's just like, so the value of the loans, and if you're using all this as collateral to back up swaps and everything, it's like, yeah, it's very questionable. So, you can do whatever you want to do on the, like, oh yeah, we'll give you guaranteed liquidity windows, and here, 500 billion. Oh, okay, yeah, here you go. It doesn't solve the longer term solvency issue, which is a big problem. And yeah, like we've been talking about this. Obviously, everyone talks about it. It's like the Fed is hiking the economy into oblivion. And here's my take on, it's nothing dramatically obvious. It's obvious. I mean, you don't know how fast it will take for these rate hikes to create a problem in the economy in terms of demand. It's like they have all these models. They basically we can basically forecast demand elasticity based on economic reactions to previous rate cycles. Well, every cycle is different though, and especially in this world, things have changed dramatically. Like, one of the reasons Silicon Valley blew up so fast is, it's like, we can't believe how fast we lost deposits. It's like, yeah, the internet banking and wire transfers and e-transfers. It's like you can move money much quicker, and also, it's like bank runs used to be, hey Bob, I read in the paper yesterday that Wells Fargo's under a little pressure. Maybe we should move some of our money out. Now it's like, Twitter, like 5 seconds later, oh my God, everyone's, so the pace of social media has made that messaging on concerns about banks is a lot faster than it used to be. And again, the ability to move money is now, I don't have to go to the bank and wait in line to get my money out. I can just go online, and like less than 2 minutes from hearing that the bank's in trouble, I've moved half my money to a different bank. I mean, you may have your e-transfer daily limits or whatever, but you can then call your your personal banker and say, I want to move $50,000. I'm, like, I know for my employer, it's like, yeah, we can move millions of dollars at a touch of a button. It takes literally maybe a minute or two. So, this ability to safeguard deposits, it's not there anymore. And so again, these models that these people built over time to try and predict, oh yeah, we've got this much capital, and we don't think we'll lose, even if we're not paying the right deposit rate, we're not going to lose that many deposits because people are keeping with it. And then all of a sudden, everyone's moving their money at the same time. It's like, we didn't predict this. Our model never predicted this. Yeah, well, you didn't keep your model up to date because you didn't, understand how technology and social media has changed things. And that's the same thing with the Fed. And they're trying to predict how people are going to change activity based on rate hikes. Well, everything is a lot different. So the models that were developed in the past are not necessarily going to work this time around. And so, yeah, like they're trying to forecast, if we hike to 6.5%, inflation will do this. Um, and there could be all kinds of problems with the models in terms of, like, again, elasticity demand. It could be like price responsiveness, supply constraints because of still from COVID or other issues that cannot be anticipated correctly. So all these hundreds of PhDs that sit at the Fed are probably, I wouldn't say next to useless, but they have not as much value as the Fed officials assume they do. And so really, I sit there and I look at Yellen and Powell, and to me, it's like, and I'm not saying I could do any better in their situation, but it's like they're flying blind. They're flying at least half blind, and especially Yellen, her flip flopping is disastrous. Like about the deposit insurance issue, for example, she undermines Powell one day and then the next day she reverses track. It's like, this is not a very coordinated policy. You're trying to instill confidence. And again, like I said, oh, your Deutsche Bank's fine. It's like, yeah, no one's believing you anymore. And that's the problem. You've lost credibility. You've lost public trust. And, the Fed's credibility was shot a long time ago, but it got worse when, if transitory is now a joke, and Powell said, I guess we should retire that word. Yeah, you should have never used that word. So their credibility is a big problem here in terms of trying to maintain calm. They've lost the credibility. So.
Well, yeah, we're way more educated than they thought. And on top of that, like you said, they underestimated the reach of social media. But you kind of started to cover into my next question here. But I mean, I still feel like you could go a little more into another aspect here. But I said everything the Fed sold off was put back on the balance sheet from the loan program, assuming those loans are going to be bad from the bank. So those are now going to be bad assets. And their number one asset currently is mortgage-backed securities, which are losing money every day. They will have to print more money, and the Feds are currently losing money as it is, and so they'll have no choice but to print. Do you see a way out of this for the Feds, or do you see this ultimately leading to some kind of a collapse since the banks can no longer loan to each other, and eventually the Feds can't put everything on their book?
Well, that's it, and I try and be optimistic about it, but like I've been saying on on LinkedIn for years, it's like the Fed is trapped, and there's no way out. You had to have a productivity miracle, which basically raised incomes and basically allowed people to pay down some debt. But the problem is that people would never pay down their debt, and that's the thing. So when you have an easy credit environment where the Fed has always been willing to step in and try and provide liquidity, it's like, yeah, the risk of being in debt is not as bad as it could be because the Fed's always going to try and repump the economy. So you basically encourage this kind of ability to carry more and more debt without paying it down. And so even if we had a productivity miracle, it wouldn't be sufficient to get people to change their behavior in regards to debt. So the other alternative is, again, inflate your way out of debt, which is called, basically monetization of debt. And that is the assumption that they're going to, the reason we don't have zero inflation targets and why we have 2 to 3% inflation targets is because, a little bit of the stupid phrasing is a little bit of inflation is like oil for the wheel. It helps things churn along, but it's also, we all know that the stats that we see are not accurate. We know that there's fudging going on. So over time, it's one way of monetizing the debt by tolerating a higher inflation level than you think you actually are seeing in the news. So that's one thing. But now it's like they basically emitting, I think they're saying, well, should we revisit our target? Do we want 3%? Can we have a 5% inflation? And again, it's like, will the populace put up with that? You're basically talking about 5 to 10% inflation being necessary for decades, and that's basically that's going to monetize your debt over time. The problem is there's so much debt, even a 5 to 10% inflation rate wouldn't do the job to get us to sustainable levels, and we're basically running into. You think about this debt ceiling issue. The U.S. debt is 31 trillion right now, and a lot of that debt has been accumulated in the last 10 years. And a lot of that time in the last 10 years, interest rates have been very low. So a large proportion of the treasury debt has been financed at very low rates. And especially debt from 2021 to 2022 was financed at very, very low rates. That's fine if you're issuing 30-year treasuries, which they did do, but they're also issuing 5 and 2-year and 1-year treasuries. And so a large portion of that new debt is going to roll over very quickly. And the Fed's saying, well, we want we might need higher rates for longer. Okay, that's great, Jay Powell. You change your target rate from 5.25 to 6.25, 6.5, and you say it's going to be there for another year or two. Well, that's great, but then how are you going to finance all this debt? And so you run into a problem like, well, the U.S. government's going to have continual problems trying to figure out where the money. You want to build up your military, you want to confront Russia, you want to confront China, you want to have the ability to fight a two-theater war. How are you going to do that when you don't have enough money to pay for military spending? So you either got to cut military spending, or you have to cut retirement benefits, or you have to cut Social Security, or whatever you're going to do. You got to make choices. And we won't pay you down our debt. I mean, you're going to say that, and that's a destructive significance for the dollar. So you're going to have the dollar crash because U.S. can't afford to pay its debt, or the U.S. is going to inflate its way with higher inflation, which monetizes the debt, which is also dollar negative. So, like all these bank debts they're talking about, like, yeah, we'll put it on our balance sheet, and you can get 100% collateral, and we'll wear that. So your bonds are lost 20%, but that's fine. We'll take it at 100%. Don't worry. But then, so how long? This program's only for a year. Well, okay, well, let's see what happens in 11 months, and whether these banks actually take back those bonds, or do they find another excuse to extend the program. So you're going to have the Fed Treasury warehousing all these bad bets from, again, these banks were buying bonds at near 0%, and the Fed's raised 6%, causing all those losses. And now the Fed's going to be warehousing those losses. And are the banks ever going to take those back at the true cost? Probably not. So this is more losses that the Fed is going to incorporate. And how do they get rid of it? Well, they don't care, because they're a perpetual institution. They can print money. Okay, well, again, you're going to print money. You're going to be inflationary. So I am, I think going to the dollar, strong dollar, weak dollar, it's going to be a very hard to justify having a strong reserve currency when you're continually printing money. And that's why Russia and China are continuing to nibble on the edges here, saying, look, we want a new geopolitical order. We were basically encouraging people to go away from dollars, especially on the petro side. So we no longer have a petrodollar. You no longer have people buying oil in U.S. dollars. Saudi Arabia said, screw that. We're not going to hold to this agreement that we made in 1971 with the U.S. We don't need the U.S. for our security as much. So we're going to basically, we're going to make deals with China. Aramco just made a huge deal with China, apparently, to set up a refining facility in northern China. So, they're going to basically switch away from petrodollar to petro yuan or petro brick, whatever they want. They're trying to get demand away from the U.S. dollar, which is going to undermine the U.S. dollar. So it's not sure, like, if this is going to be a 6-month process or a year process or 12 years or whatever it's going to be. But the ultimate problem is that the dollar is quickly it's being undermined on many, many aspects, and the U.S. is doing it to themselves in some respects with all these bailouts. The inability to be fiscally disciplined. It's going to cascade into a dollar collapse, and then that leads to, they'll just have a digital currency. So I'm sure that's going to be one of your questions. So
I was like, you literally just covered one of my questions. I was like, other countries are getting away from the dollar. Do you see this becoming the next domino as well down the road? But you already covered that, so good job. All right. So the next question was going to be, FDIC is maxed at 100. Baby, stop.
Yeah.
FDIC is maxed at 128 billion. The debt ceiling is maxed. What do you think will happen now if another bank domino happens? Will this force them to raise the debt ceiling, or what else will they be able to do to cover these?
Yeah. I mean, that's the thing. So the debt ceiling is a bit of a joke. I mean, I said we've had debt ceiling crises. I don't know the number. In my career, I've seen at least like 6 or 7. It's always the same. And this time has been different because usually they find a solution within a few weeks of passing the deadline date, which was months ago now. So right now they're relying on not paying into Social Security. So we'll pay federal pensions when this thing's resolved, and we'll catch up then. So that's how they're deciding. But I mean, that the ability to continue to play around, the ability for the Fed and the Treasury to screw around with payments, it's diminishing. And now you've got a banking crisis in the middle of it. So, I mean, it really comes down to, are the politicians going to, like, this is why Yellen's freaking out, because it's like, usually it's like, this is a big problem. This is a big problem. And now she's actually saying things that I just said. It's like, if we don't solve this debt ceiling crisis, it'll undermine the dollar as a reserve currency. Yeah, no shit, it will. You're getting to, like this is basically you told the wife you're going to be home at 11 p.m. and now it's 6 in the morning and you're still playing poker and there's a big pot and you don't want to go home because you're going to get in trouble one way or the other. But it's like you're ruining your long term marital health by dicking around, staying around. You should fix this and you basically cancel the game or split the pot. But no, you keep playing and so like the politicians on all sides are going to have to come to the realization. It's like, you know what, you might get a short-term gain out of this for your constituency or whatever you're delaying this debt ceiling agreement for, but you're killing the U.S. economy and the country's well-being. And it's like, does anyone have the wisdom to see that? I mean, and so I think Yellen's an idiot, but she's right to be yelling. She's yelling. Yellen's right to be yelling because it's you're really pushing it to the limit here. Within another month or two, this is going to long-term damage to the U.S. dollar, and it's already happening, right? I mean, it's going to accelerate. And to me, it's kind of like I've been railing about the U.S. stupidity in regards to allowing J.P. Morgan to suppress gold. We'll get to that, but so that's one issue. They've been like, this is like, you're just encouraging people to say, yeah, we don't want the dollar. Like, this is too many issues with it, and they're just, the U.S. is too arrogant with the way they treat everyone else. And this goes back to 1971 when Nixon took the dollar off the gold standard. It's like, you just screwed everyone else but the U.S. Yeah, oh, that's your problem. And it's like, they got away with it because the U.S. was the sole superpower, and to some extent they still are right now. But it really is a question of like, you got to get this debt ceiling fixed, and if they don't, like in this banking crisis, basically you may have another like, okay, let's say if they don't do anything, there's not enough deposit insurance. That's undermining confidence in any of these other banks, regional banks that are under pressure to get safe. So yeah, First Republic, National Bank, or my favorite on the internet, people are again targeting Schwab, and Schwab, if I understand correctly, is also the owner of Interactive Brokers. So again, yeah, maybe this meeting on Friday was relating to like the entire infrastructure is under pressure here on multiple fronts. So if you don't get this debt ceiling resolved, if you don't have some ability to increase the amount of deposit coverage, you could very well see multiple brokers, starting with Schwab, go down. And Schwab's got the same problem. They have losses on securities that are exceeding the capital of the company. If everyone took their money out of Schwab tomorrow, you would have an instant collapse of the institution. So, yeah, it's ugly. And so, yeah, it boggles my mind that the politicians are still playing this game when they should just like listen. It's hard to listen to Yellen seriously, but yeah, like in this case, they should be. They need to fix this debt ceiling issue, and it's a self-inflicted wound, and it really. It just speaks to the turmoil in Washington. It speaks to the turmoil in there's just too much going on. And like I think we talked to last call, I was saying there's these multiple balls in the air, and you could have a ball off stage that someone else is juggling, and they drop that ball, and all of a sudden it distracts you, and you've got like, that's exactly what's happening. There's multiple jugglers with multiple balls, and someone's going to drop something, and it's going to cause a cascading effect where everyone's going to drop stuff. And I think we're very close to that. So I do think this debt ceiling is, again, in the past, no one's really thought it's serious because they always came to a solution at the last minute. Well, this time there's too much at stake, I think.
Yeah, and can you hear me right now? I have to back up. They said too loud. All right, so this is why I believe we need a moass, because I feel like the way the United States is set up is everything's to siphon from the middle class. And this is why, well, this will lead into my next question here too. But so you either need to, reinflux your middle class with cash, or you have no other choice, or you're going to start seeing mortgages fall. You're going to see their companies, the thing that make them rich, lose value, which loses collateral, which loses, these guys' money. And at the end of the day, you cannot keep doing what you're doing. So you need a moass or a reset of some kind. And since we've been talking, that's why I've been telling everybody, we need these certain things to happen and get them stretched to the point where these banks have no choice but to margin call these companies because they don't have any collateral themselves anymore. Do you agree with that?
Yeah, I mean, to some extent, it's like, yeah, like the wealth destruction of the middle class is going to undermine the U.S. economy because again, it's like there's all kinds of debates whether capitalism versus communism or socialism, and what are the merits of both. But ultimately, the benefit of what you've had created in Western economies is the ability to create incentives to strive to work harder, and part of that is accumulation of wealth by not just the 1%, but the entire. If you're going to have a more well functioning, innovative economy if people believe that if they put in work they get rewarded for it. And what you've seen is because the rules have been so tilted for a certain percentage of the population, it's becoming like, again, in 2008 was a disaster. Now, like, from my point of view, I was not directly involved, but I was in the banking community, and I see Occupy Wall Street, and these people, their homes were destroyed, their livelihoods were destroyed, and meanwhile the banks, only one person was charged for, and that was a minor crime. So, the banks didn't suffer any major repercussions. It's like too big to fail. The banking system's too important for the well-being of the economy. But ultimately, it just accelerated the structural tilt towards the 1%. And you basically, it took a decade or two for people to even get back to where they were in 2008. And a lot of people has probably never recovered. And so as a result, you've got this declining. They say, oh, household wealth's great. Look at the equity prices are up. People are better off, but it's not well distributed across the entire population. Even if you exclude the 1%, you've got pockets of value. And again, it's like, if you happen to be lucky enough to have owned a home in San Francisco, 10 years ago when, the Silicon Valley was going nuts, it's like, yeah, you're well off. But like, if you're sitting there in Pittsburgh, you're not. And then, it's like the thing with equity ownership, it's not that it's distributed well across the middle class. It's like if you have the extra capital and you've been allocated to the equity markets, then yeah, you would benefit from the craziness that we saw. But then we've seen the complete reversal of most of those gains. The margin, everyone's trading on margin, and they've been killed. If you're trading on interactive brokers using margin, you probably have been nuked. And that's the thing. They keep inciting us to go buy the dip, and using margin to do it, or using credit cards to make expenses while we used available capital to buy new stocks at lows. Oh, this is going to be bounced because, the Fed's always got our back, and the Fed has screwed everyone up in the last year by changing that. So the Fed not, trying to withdraw liquidity has basically cost everyone in retail, in the middle class that had been invested in the market. They've taken hits. And so, yeah, like the wealth distribution has gotten worse and worse. And so even if there was a moass, though, I do wonder how many people were in the play, for one, that have been kicked out and couldn't afford to stay in, because it's taken so long, because the other side was allowed to delay and manipulate. And that's one concern. And the other concern is the people that were never in the play to begin with, they're still disadvantaged. And that is not good for the long-term health of the U.S. economy when you have most of the wealth concentrated in a small sector, and yet, like, everyone else is basically subsistence. I mean, I'll be honest, it's subsistence level. It's like you see a lot of people saying, yeah, the number of households that making $100,000 living paycheck to paycheck is like, it's like 57% or something stupid like that. So $100,000 in New York will not get you anywhere. And I see,
so
like,
equals 36,000 nowadays, and it's 62% when I looked last.
Yeah, it's just obscene. So, like, they've got to do some major. This whole thing about, like, again, the Silicon Valley Bank is particularly egregious because, most of the people that had money there were not like 250,000 or less. A lot of them were like multimillionaires that made money, scamming people out of SPACs and stuff. So, a lot of people that had money in Silicon Valley Bank were not like the middle class; they were the upper class. So you're going to go bail out this bank and get taxpayers' expense, again, incorporated it via the Fed and the Treasury, and basically going to be financed through devaluing the currency over the longer term. So you're going to hide all that payment, but it is the middle class that's taking the brunt of bailing out these banks. And so, yeah, you need some kind of retribution. You need to sort of redistribution, I should say, of some of this. As I said, it's longer term. You're undermining your middle class, which turns you into a banana republic. And it's just a bigger example of a banana republic. And it's again, if you want to be a proponent of like capitalism on extreme becomes crony capitalism, becomes like the Nazi, I don't want to call we're going into Nazism, but it's like you have control of society dictated by a certain small percentage of people, and that's not capitalism anymore. That's indentured serfdom, and that's where I think we could go if this trend continues. And I don't want Bill Gates being my master. I know. So I do think they need to provide some kind of, like, if there's anybody clear thinking in Washington, they need to recognize that, yeah, like the way that the stock market has been promoted as a way to enhance middle class wealth is yet basically a method of fleecing middle class of what it's the rare exception of someone who's been significantly better off investing in this equity market over the last 10 years. So yeah, I think it's a big problem, and I don't know whether they have the wisdom to address it properly. But certainly they can see like the degree of shorting going on in so many industries, and these regulations have been basically designed for them to be able to delay payment, and it's like, yeah, my disgust level in the last 2 years has grown to enormous heights regarding the administration's willingness to facilitate this. And it's like people say, "Oh, America's terrible, Europe's better." I don't know if Europe and Canada are that much better, but they certainly aren't as stinky to the degree that the U.S. regulators have. It's absolutely disgusting that this has been allowed to go as much as it has. So anyway, it's more emotional for me than intellectual at this point. But yeah, I do believe that there has to be some sort of, they have to give back some of the wealth to the middle class for the longer term benefit of the country.
Well, not even that is intellectual too, because like we were saying, if you keep taking from your middle class, you crumble from within. So you have literally no choice. If you keep taking the banks out, you keep putting yourself in a worse and worse position, and eventually it has to be addressed.
Yeah. Yeah.
But
I mean, like, again, I'm not one of these people that's like, there's a certain angry percentage online that were, intimate, certain kinds of revolution. And yeah, the ultimate problem is at some point you do have a sort of a Cuba situation where that exactly happens. Right. So it's a difficult topic, because like people at some point say, look, I had all this wealth and now I'm impoverished and I can't even afford to buy eggs, and my kid's starving. What else choice do I have? And that's a problem, is at some point society breaks down. And the US has got enough social fractures right now that the economic disparity contributing to that will inevitably lead to social deterioration, and that's a big concern.
Yeah, I mean, I always say I know we didn't plan on us holding this long, but the thing is neither did they. And the way it's designed is if we just keep at it, there's nothing they can do. Eventually, like I said, they have to pick us or collapse everything. Nobody will be able to do anything.
Yeah, exactly.
So when we first started talking, we started. I always said there was going to be a bond crash and then a housing market crash in the United States. They're saying right now that under the higher mortgage rates, you're seeing the housing market's actually crumbling within. You see, they're going to have to keep raising rates, so it's going to keep, everybody's making less and less. 1 second here. What I said back then is I was worried about what that would do to the feds and their assets, because that would drastically drop it. But you just said that they would hold those assets until they would regain their value. But do you now think that there's going to be a housing market crash in the United States, and could that be another bomb to just blow this thing over?
Yeah, I think we've talked about this before in other calls. And the thing that is uncertain for me is it's a peculiar aspect of the U.S. mortgage market. So U.S. house owners have like historically speaking, since like 1930 or whatever, the U.S. has favored home ownership, and that's creates a lot of incentives to own homes. And one of the ability is you can take out a 30-year mortgage, and the nice thing is, you take out a 30-year mortgage at 5%, and they drop the rates to 2%. Oh, I can refinance this entire mortgage at 2%, and I don't have to worry about it anymore. So whereas in Canada, we take a 30-year mortgage, but we have to refinance the rate every 5 years. So we have to worry about repricing risk on our mortgages. The typical bank cycles are about 2 to 3 years. So it's not a huge problem unless there's a dramatic change in like going from 0 to 5% in a year. So that's a concern for Canada. And we've had like a really ridiculously heated property market here. And people have the ability to take 5-year fixed, and so most people, there's a certain percentage that do take floating, then they have the ability to go into fixed. So we haven't seen a meltdown in Canada yet, but if interest rates were to stay at these levels or higher, going into another year or two, we could very well see a real estate collapse in Canada. So that's a big concern for me here. Now, down in the U.S., again, because you have the ability to finance 30-year mortgages, how many people were smart? And I would suspect a lot of people were smart that basically had 30-year mortgages or 25-year mortgage, whatever the term was left, and they refinanced at a lower rate. So the pressure on the real estate market may not be as bad as some people think. However, it's not clear. There's a lot of people one of the benefits of the U.S. and even so the Trump administration didn't want to encourage immigration is what's keeping U.S. demographics hopping. It's like most countries, U.S. has relatively positive population demographic structure, whereas you have a lot of younger people that still need to buy houses. So there's demand for houses in some respect, but again, if these people just recently bought a house in the last 2 years, and they took floaters, so they took whatever crap Bank of America is doing with we'll give you 1% for the first year and then it's 10%, year two. So how many of these people bought a house with a teaser rate and then are getting screwed as it gets reset at a much higher rate? So that's probably what's driving a lot of this concern over the mortgage market. And I don't have a good feel for that. Like I said, it's possible that, Joe Smith in Topeka, Kansas is okay, but Jose, who just bought a house in Las Vegas, I don't know. That could be a big problem. So yeah, to the extent that the Feds continue to be ridiculous and say, higher rates for longer, you're going to keep basically the bond market elevated, which is going to keep mortgage rates up, and that will cause at least people that have incentive mortgage, like teaser mortgages, or people that for whatever reason weren't smart enough to, and actually the bigger problem then is not the owners, it's the renters. So you got this place and the landlord, is basically has his own mortgage and he's got to refinance at a higher rate his mortgage. So now he's going to pass on that rent to you. So the bigger problem, I think, is actually renters in the U.S. Who are more susceptible to basically getting screwed as rents get increased well beyond what they should be, just because the owner, the mortgage. Again, this is a commercial real estate issue too. If you're just immigrated to the U.S., you've got 50 grand in capital, whatever, you open a franchise store, got your Subway, and hey, the business is slowing down. Subway promised me a lot more flow than I'm seeing. I got to pay all these franchise fees. Oh yeah, now the mortgage, the commercial mortgage that I've got is going up too, and I can't afford to raise prices because I don't have enough customers. I got to shut down my franchise, and I've only been doing it for a year. And that's what I see as a bigger problem, is the knock-on effect of all this financing, not just on the mortgage holders, but the renters.
Yeah, no, I agree with renting as well. One of the things I wanted to ask is going to lead into my next question here, but Evergrande has now lost 91%, basically all of its value. It's now trading at 0.00030. I see them falling within the next week or two because it literally just can't go. Basically, it's at zero at this point. It can't go anywhere else. Yeah. That's the next part. But do you see them failing in the next 2 weeks? And we already know how big of a bombshell they have in the derivatives market. Do you see, if they do go down with all that toxic Chinese asset, that could spill over into our banks, and that could now, with the crisis going on in the United States, lead to a huge, pretty much bomb?
Well, yeah. As for whether they completely go to zero in the next few weeks, anything's possible. I've been not following the Chinese property market for the last year. I kind of put into the sleep mode because the Chinese were basically delaying everything. Now, my understanding is that for loan guarantees, as soon as they were declared bankrupt, that should have null and voided the collateral. And whether they were able to get extensions to all that and disregard that is possible. So I don't know if a lot of that hedging has already been oh yeah, this collateral is all worthless. It would be silly for someone not to have marked down the collateral value of this to near zero already. So I don't know if the actual going to zero, the stock price matters, but anything, like you said, the number of delay tactics that have been used in our play, so for Evergrande, I as much as I think that any responsible manager would have marked down the collateral value of this to zero already, I can't disregard the fact that maybe some didn't for some ridiculous reason. So yeah, I think it's possible it could have a knock-on effect, and it's coming out, of course, the worst time. I just would find it hard to believe that responsible manager wouldn't have already marked down that collateral to zero already. But yeah, how many times have I thought, well, I can't believe Credit Suisse would have done this, but so.
Yeah. So when I first started this space, I pulled up this page on Wall Street, it's Wall Street on Parade. It talks about the next bomb going off is going to be the derivatives market. And when I first started talking about everything, I said that the derivatives market is where it's going to be. I believe that it's going to happen because of the phase 6 collateral drying up, with the dollar losing its value, people getting away from it. These banks are losing control in the derivatives market. And I said that this would lead to the Great Reset. If a derivatives market explosion happens, do you think that the United States could recover from that, or do you think that would be the reset of some type?
Well, yeah, like that's like it completely unknown. Like, and this is my concern is I don't know if U.S. administration has a clue as to, like, we can all see derivative exposure, that you point to, and it's like regulators really haven't. Oh, it's all netted. Don't worry. It's like the total exposure isn't as bad as you seem. But you had the BIS come out months ago saying they're 65 trillion in U.S. dollar swap exposure, and they don't know where it is. So
well, it's up to 80 now. It's up to 80.
80. Yeah, it's like you don't know where the exposure is, so you can't say, oh, it's okay, it's all offset with each other. No, it could be that one institution has like a huge proportion of that exposure netted with everyone else, and if they go down, then everyone else goes down with them, and that's why I think Deutsche Bank is a problem, because I suspect that they do have a large U.S. dollar exposure. Now, the interesting thing is, so if you were relying on U.S. dollar collateral, because it's a safe haven in times of stress. So now the U.S. dollar is under threat because of all these inflationary issues, and they basically ripping up the FDIC playbook that undermines the whole trust in fiat. So if you have concerns over the value of fiat, and it's like, like you get into Bitcoin or whatever, it's like gold and silver, but it really undermines the value of that collateral, because if that collateral is based in U.S. dollars and the U.S. dollar is now under pressure because of fiat concerns, then again, you don't know what the value of the collateral is. You assumed, like treasury bonds, 100%. Everything's under question, because when you create a set of rules, everything in finance is ultimately about trust. I mean, you can have laws and regulations, but like, look at Swiss National Bank basically screwed 17 billion of bondholders. Now, you read the fine print; they should have been aware that they could have been screwed over, but they made the naive assumption that they would never do that, but they did. And so, like the FDIC, systemic banks are immune to this 250 limit. We will, how do you decide who that limit is? Oh, I decide. Oh, so faith in the U.S. dollar is now on Janet Yellen's shoulders. Okay, so that's going to undermine confidence in U.S. dollar, and that's going to undermine potential value of collateral, and that's something we haven't seen. And again, if she's warning about a debt ceiling crisis, and the U.S. could get downgraded, and U.S. dollar reserve currency will be under pressure. Yeah, okay, then that's going to undermine the value of all the collateral that underlines the entire financial system. So it really is like we are in a I don't want to say dangerous time, but it is. As I said, it's going to be concerning, because I don't believe that regulators have any clue where the bombs are, and I think they can hope that the explosions won't be too bad, but they have no idea. It just feels to me like they're winging it. And based on my time at the Bank of Canada, and we had less information back then. There were times in, like, I remember the Asian currency crisis. Like, we didn't have any idea where it was going to end. The Russia default. I was at TD at the time, but it's like no one knew exactly how bad it was going to be. Y2 trade crisis. We all overestimated how bad it would be because we didn't know. So, like, err on the side of being wrong on that one, and it wasn't that bad. But this case, I don't think regulators have any clue the derivative exposure. And when I went viral on LinkedIn 2 years ago, almost, this was what I was trying to get to if you're letting these guys naked short to oblivion, do you even know what their exposures are? Oh, there's no naked shorting. It's like, yeah, okay. It's like, it's not, gaslighting me is not going to solve your problem. I mean, I was long AMC and wanted to squeeze, but ultimately I was trying to be helpful to the authorities, but I mean, they're not going to listen to me apparently. But they've allowed these systemic pressures to build up to a point where I don't know what's going to happen, and so I try not to be scaremongering. But it's like I honestly don't know how bad it's going to be, and there's nothing they can do. Like they need to basically they need, like I said, it needed to pop the cyst. It's gonna be painful, but you gotta drain some of the poison before it toxifies the entire body, and that's my concern. Is I don't know if it's too late. So
No, I agree with all that. I have about 4 pretty good questions left. Do you still have time, or?
yeah, I should. Yeah, I got a few more minutes.
Okay. So my next one was gonna be. 1 second. Where to go? One person wanted me to ask, with everything collapsing, do you feel, would you trust brokers, or would you want to DRS your shares and get them in your name now?
Yeah, so that's a hard one for me, and so I have my shares are in a retirement account. I've never DRS'd them. So, and I've listened to the pros and cons, and one of the pros is, like you insulate yourself from potential broker packs. I don't know, again, like I've had people ask me about Schwab, and I sort of gave them the answer, like if you have it all at Schwab, maybe you move it to some of it to another broker, diversify your risk. But yeah, what if they all go down? I don't have an answer to that. I don't know if DRS is going to insulate you from that. But I would definitely. And I don't know if Schwab is going to survive, or if it's it's just a short attack and they're actually fine. But I do think it's prudent to diversify your holdings among many brokers. And yeah, people ask, well, what about the Canadian banks? Because there are a lot of my, they know I'm Canadian, so that's been. And I always say is like, I'd rather be at a broker that's owned by a Canadian bank or a large bank, just because they're well capitalized. In Canada's case, if we had a problem, like if the Canadian banks go down, then the entire economy is screwed over. So the government will do something to prevent that. So yeah, like Scotia iTrade or RBC or whatever the CIBC platform is, they're probably safer than Questrade or some of the again, Interactive Brokers. I have an account in Interactive Brokers. I've moved most of my money out of that because Thomas Petterfy seems to be shorting meme stocks, and I'm annoyed with that. But the other thing is just I do wonder their financial stability. So that's all I can. Again, everyone's got their own. It's not financial advice, but that's my view. Is like I prefer to be at a larger broker that I know is well capitalized.
Thank you for that. The next question I got is, do you see a domino effect coming to the banks in the United States, or do you think they'll actually be able to contain this in the next coming weeks?
Well, we'll find out. I like honestly. The one thing is clear that if things are allowed to continue as they are, you're going to have a concentration of risk into the larger, too big to fail banks. Whether some of those are actually under pressure because of derivative exposure is a different question altogether. So if there was no, like again, if everything was just U.S. regional bank issue, then it would stop after a few more regional banks turf it. And like again, the longer term impact for the regional banks is if they don't change the current deposit policy, you're going to have people basically taking money out of the regional banks, except for the smaller clients. They're not going to be able to be aggressive. It's going to cost them more to raise capital. They're not going to be able to grow. And you're going to have a slow diminishment of regional banks. Ultimately, they'll probably be taken out by, they'll merge with each other to get bigger because they have no other option. And you'll have some really ridiculous combinations that don't make a lot of sense other than the fact they need to be bigger. So that's my concern is you'll have either a bunch of regional banks being taken over by the Citibank or whatever, or you'll have SunTrust Bank and PNC Bank, which are two different markets, but they'll merge together and form some stupid name. But that's not unusual. I mean, Wells Fargo, I think, was taking over whatever Carolina Bank. I can't remember the name of it, North Carolina Bank. So there's been this kind of stuff happening before. I think it'll just see and whether a smaller number of banks is a bad thing. If you look in Canada, we have 6 major ones, and some people say this is bad. Some people say, yeah, it's fine. And in Europe, you've got one bank in Switzerland now. So that's the regional issue. But from a like the derivative exposure, I honestly don't know. And I think it'll be very important to watch what happens with Deutsche Bank in particular next week.
I'll ask this one first before I get into my last one. Well, actually, I'll do this one first because you kind of basically covered it. I was going to say, I believe that this was a planned attack to move retail and other people into these bigger banks. In the last year, $1 trillion has been moved away from these vulnerable banks into the big banks. And I believe that this was for collateral that is being lost through phase 6 and these ISDA contracts. Do you believe this is a last ditch hope for these big banks for collateral?
Yeah, no, that's an interesting question. I don't know how coordinated. Like again, you could come up with an analogy of like a Simpsons episode where Jamie Dimon and everyone is at the New York Fed and they're plotting, how are we going to get through this next crisis? Okay, well, we'll just screw the regional banks and use them for our survival. Does that actually happen? I don't know. I do know, for example, that hedge funds in Connecticut or whatever, they get together for dinners and basically collude. So does would a longer term collusion between the big banks happen? How they say with the Fed, this meeting's off the record, but we'll discuss how we're going to deal with this next crisis, and we'll sacrifice the regional banks. I don't know, and it's not out of the question. My experience is unlikely, but again, hedge funds are clearly colluding, and even though they're not supposed to, so the big banks collude to against the regionals is possible.
I saved your favorite one for last. JP Morgan's been caught spoofing and manipulating precious metals. They said they had a massive short position bigger than their assets. What are your thoughts on precious metals and JP Morgan?
Yeah. So before I got into AMC, I was big into silver. In fact, like my first exposure to this whole Twitter meme verse was I was looking through Reddit and I got the silver bugs in Reddit formed Wall Street Silver, and I got involved in that. And it was clear from just I had been in the gold market at the Bank of Canada. I was actually one of the traders that sold the rest of Canada's gold reserves back in 2000 or whatever. So that's kind of a dubious claim I can have, but so Canada has a lot of gold in the ground, so it's not been the assumption is if Canada needs gold, they can always reconfiscate miners, force the miners to sell it to us directly. But needless to say, so I'm aware of the gold market, but I wasn't aware of the degree of manipulation that went on. And as I sort of got into the Reddit crowd and everyone, it's amazing. And said, what I've seen people do for AMC and DD and stuff is not surprising because I saw it in the silver community as well. And, they're basically targeting what JP Morgan has been up to in the last 20 years. Well, let's put it honestly. So JP Morgan was a non-entity in precious metals until they bought Bear Stearns, and Bear Stearns had the biggest physical stack in the banking world. So JP Morgan was able to buy Bear Stearns at a discount, a huge discount, and as a result, they picked up the dominance in the precious metal market. So since 2008, JP Morgan has been controlling the market to some extent, with the other bullion banks playing along. It's not a monopoly. It's an oligopoly. There's six bullion banks that really control things, but JP Morgan's the biggest. And they have, of course, been implicated in a price spoofing scandal that took far too long to play out, but they were fined almost 900 million. And the head trader and the head of the precious metals desk have been found guilty in court, and they are now being sentenced. And the government is recommending 5 to 6 years of jail time, not SBF house arrest or anything like that. They've already done their house arrest time while they were waiting for the trial to finish. But now the government wants 5 to 6 years, and given the convictions for basically wire fraud and these are under RICO Act, by the way. So this is not minor stuff. They had to charge JP Morgan under the RICO Act, which again, so this is what drives me nuts. So you found a bank guilty of RICO fraud, and yet you allow them to continue business as usual as the lead precious metals bank. It just boggles my mind. But anyway, their head the head of precious metals trading for the entire bank is going to go to jail for 5 years, in jail, in a prison cell. So they're guilty of sin, and that's proven in court. And meanwhile, business as usual, and we can see, you look at the price action, and I follow silver more than gold, but you can see these ridiculous things that go on at like 4 in the morning. London's just opening, and there's no liquidity, and all of a sudden it drops 50 cents on nothing. And sometimes it's related to what's happening in the DXY, the US dollar index. Basically, a lot of hedge funds have got their algos set. So if DXY goes up, they sell silver. DXY goes down, they buy silver. But it depends on their position. But a lot of the times, these dumps happen to take out stop losses. Like what would happen is a certain, maybe a pension fund would say, yeah, we want to have some silver exposure, we want to have some gold exposure, so we'll buy some futures contracts. And it's like, oh, but we have risk tolerances, so if it moves 3% against us, we got to get stopped out. And so like the dealers know this, and so they basically do these raids at 3 in the morning to take these guys out. And it's like there's no liquidity, they can easily, so you see these drops, and then all of a sudden 2 hours later it's back to where it was before the drop. It's like it's BS. But like longer term, they've controlled silver, especially since the 2000 and like basically January 2021. Well, I think it was February. So it was right after GameStop did the big move and removal of the buy button. But yeah, silver had the jump from like 25 up to $30. They basically came in. The CFTC increased margin on futures, and then they took a crap load of physical silver out of SLV, the main ETF, which JP Morgan controls as the primary member of that SLV. And then they just basically dropped silver like crap. So that, we haven't seen silver back at $30 since, despite the fact that like retail has gone ape shit, excuse language, on buying silver physical. And, you go on Wall Street Silver and people are continually talking about they're adding silver every day. And just an aside, of course, the GME elitists hated this because it's like your silver's a distraction play. And I thought that was stupid at the time, but now I think about it, it probably was a distraction play. But it's a fundamentally correct distraction play. That's what made it so insidious. Is like silver should go up, gold should go up. There's not enough supply relative to demand. And if you have a fiat banking crisis, which I anticipated again 3 years ago because of what the Fed was doing, I wanted to be long silver, and so it made sense to be this. And so we've seen J.P. Morgan and others continually smack down silver every week, every contract expiry, they'll dump it down. So the miners that have basically said, we got product, we're going to sell it at the 25th of the month, and so they knock the silver price down on the 25th so that the producers get less for their silver. And the result of this is that it's like there's less exploration because the silver price is suppressed. There's less silver being, mines are being closed. Miners are laying off people, or you have like Keith Neumeyer at First Majestic basically saying, yeah, we're holding silver back, we're not going to sell it because these prices are too low. But of course, then that causes cash flow problems for them, so they can't expand. So there's been just like what Citadel's accused of destroying cancer research companies. It's like these miners are being destroyed by the bullion banks. And the idea is you want to destroy these miners so then you force them to take loans from you. So you're continually a captive, like you got to sell your silver to the bullion banks because you have your loans with them. So if you don't want to default on your loan, you've got to take the contract to sell at a certain date to these banks, and then these banks manipulate the price so they get the lowest price possible. So it's not surprising. It's everything you've heard, you've seen in AMC and everything else, but it's just these bullion banks are bullies, and JP Morgan is the biggest. And yeah, whether they're short position in gold, I don't know, because I heard they were actually long silver, and is Bank of America, who's of course Citadel's prime broker, who was actually the one aggressively, banging silver lower. And that's another connection I should just point out. So when FTX blew up, like people who've long silver suspected that there was some sort of connection between silver and the meme stocks, and again accused of being a distraction play. But when FTX blew up, the ex-CFO was from Citadel, of course, and they had a Wall Street bet index at FTX, and it included silver in it along with AMC. So, the AMC and the 500 million magic or 400 million magic tokens that FTX had, well, they also were, who knows what they were using to manipulate silver, but it's all related. And so, yeah, the actors that have been involved in suppressing silver are also the actors involved in suppressing the meme stocks. So there is a connection there. And, as far as I know, Bank of America was the more active shorter, but JP Morgan has been shorting in the past. And of course, caught guilty of spoofing, and we know spoofing happens in AMC, we know spoofing happens in GME, so it's all the same BS. But I do think fundamentally, it may be that a loss in confidence in U.S. as a fiat will drive precious metals higher, which may, in fact, cause problems for the shorts and help AMC squeeze. So, like again, some people think that precious metals may lead a squeeze in AMC. So,
I agree with that, man. I've been kind of hinting at certain ones and land and. I thought I had one more question, and did you have time to answer a couple more? I don't have to go, but I don't know if you're on a time crunch or anything.
I'm not in a huge rush, so yeah, I can, as long as they're not, we'll see what the questions are. Yeah, sure.
All right, well, this is my last one I wrote down. I forgot I didn't put it on my notepad, but U.S. banks now are sitting on 1.7 trillion unrealized losses with rates going up again, and that's going to keep obviously going up with that. Do you see that? Are they going to be able to contain that? Do you think that's going to be a massive problem, or is that going to make all of these small banks have this domino effect, and there's no way they can contain that?
Yeah. So where are the losses held? Are those losses held at Citibank and J.P. Morgan? Well, the thing with that is, if you look at that bond pawn shop facility, it hasn't actually been utilized that much. It's mostly been the discount window that's been utilized, and for that reason, like J.P. Morgan can hold these bond losses a lot easier than Silicon Valley Bank could, and same with Citibank. So the initial thing again is assuming it's just a regional bank problem, and these bond losses are like, again, it could be mostly with the regional banks. I suspect it's spread around all the banks, but J.P. Morgan can deal with that and not panic, because they have the ability to raise funds so much more easily than the regional banks can. For example, J.P. Morgan, because of their investment side, they can easily go issue commercial paper or whatever. They don't have a liquidity problem. The regional banks have a liquidity problem. Now, the bigger problem is the derivative time bombs. So if those start to go off, then I don't care how big you are, you're going to have problems. So the exposures to me in terms of the bond losses are a symptom of the bigger problem, which is all these swaps were, they were under collateralized because, hey, the Fed's going to keep low rates for lower. We can make some BS valuation for these swaps on the assumption that the rate volatility of these contracts is going to be low. So all the volatility, inputs for these contracts were basically not subsidized. They were basically suppressed. So now we've got interest rate volatility, and as these swaps come to be correctly valued, the more collateral is required. And if there's no collateral available because the value of the collateral is questionable because of cocoa bonds and whatever else, yeah, it's going to be a domino effect. And so yeah, like I think it's the bond losses are symptomatic of the fact that the Fed has completely effed up Wall Street, because they actually believed the Fed when they said low rates for longer. And the Fed probably would have been happy to say low rates for longer, but inflation became too big of a problem. Their credibility was at stake. So it really is like, at some point, the Fed has to decide whether they want to crash the financial system or have credibility. And I think ultimately they don't have credibility anyway, so they might as well try and save the financial system. So I expect we'll have inflation. But in the meantime, sound and violence signifying something.
Yeah, sorry, my phone wasn't letting me unmute. Yeah, man, it's going to get real interesting. This upcoming week, I think, is going to tell, a pretty good tale here. If we see a couple domino effects, we know they're not going to be able to contain anything, and it's going to get crazy. Yeah. I have a couple of people asking to come up. Do you want to answer one or two questions quick?
Yeah, we'll see how it goes. I got like 2 or 3 questions. We'll see how it goes.
Yeah, I'd like more like 1 or 2.
Yeah.
What's up, Toasted?
What's going on, brother? How y'all feeling, man? So I wanted to kind of like key in on the fact that, I mean, even landlords, right? They're milking what's going on right now, right? So what happens once they're placed in a position where they have to have that money, right? So assume that there's 60 million, 50 million properties not rented right now, right? And they need to get those property rented to be able to keep up with their loans and X, Y, and Z. Wouldn't this actually help decrease how much rent is, right? If they're, because I know in the field I'm in, I got a guy that, I just rehabbed two of his properties, and in that situation he initially wanted to rent them for $2,200 per property, right? And he ended up renting them out for $1,100 a property, right? And that's probably like the six in the past couple of months. That's probably the six time I've seen that, and I'm kind of seeing that coming down, and I could clearly tell that these individuals are in, stiff financial situation right now. And I'm also noticing that, what people were getting paid, right, the incentives to kind of get people to work, now is coming down on a lot of these jobs. Kind of like at a certain point, I seen McDonald's starting off at $18 an hour, right, and now that's back down to $9 an hour, right? So I'm seeing that in Atlanta right now, and I'm also seeing landlords charging less for rent, right? So it makes for a less competitive market, right? If you have these properties over here that are still being listed or sitting listed for 30 days at $1,800, right? Well, if they're not being rented, they need to keep that money coming in. If they have six properties and they have six different mortgages on all those properties, other words, they're hemorrhaging money, right? So you start to see a decrease in that rent, right? Which starts to kind of combat some of that inflation, right? How do y'all feel about that?
Yeah, so you got six properties and you can't rent them all. You got two choices. Well, you're going to have to sell one or two of those properties, right? Or you're going to have to if they're sitting vacant, it's no good to you. But like this is the thing. It's like you got to do a cost effectiveness like base. How much do I need to be able to pay off these loans versus like can I even afford to keep this loan? So like if you're basically got capital value in the property, you're going to want to sell some of those properties, and that way at least you can pay off the mortgage and have some money available so that you don't have to lower the rent on the other properties. Again, it's like a cost benefit decision on how you're going to maximize your situation in terms of cash flow. But yeah, point in general, the economy is going worse. So you work for Twitter, you've been laid off, you got 3 months severance. You can't afford to keep your apartment. You tell the landlord I got to go, and the landlord's like, oh shit, I can't lose this guy. I'm going to have to give him a deal. It's like, but even then, it's a dubious proposition because the guy's out at Twitter, and how fast can he find an equivalent job when Meta's the same job at Meta's been canceled as well. So I think the landlords are in a big problem because they've got like increased financing costs from the lenders, and they don't have enough demand. And something's got to break. And in your example, it's basically the landlords are basically going to break. But maybe it's just like okay, the bank forecloses and takes over the property, and then the property values decrease. I mean, it's something has to change. Either the bank is going to take some hits and foreclose and lose money on foreclosing, or the landlord's going to have to take less revenue, which means he's going to have to sell more properties, which are going to decrease property values. Or, the person renting is going to have to pay twice as much as they were, and they're going to eventually say, "This is not workable. I'm going to go find a job in like Detroit or something where it's a lot cheaper." And if that's the thing, like people like Elon Musk are causing chaos because it's like, yeah, like no more remote work. Well, the whole thing was like Silicon Valley was too expensive to work in the first place, so people were like moving out to the valley. Well, if they can't do that anymore, well, they're going to change jobs entirely. So it's a huge knock-on effect, and where it stops is not clear.
So I feel like they have to either get CBDCs in place at this point, or there has to be a moass of some kind, or an influx back to your middle class. There's too many bombs going off at once. How they can contain this.
That's a great point. We didn't talk about digital currencies, and that's the ultimate destination, I think. Unfortunately, I do think that digital currencies have an element of social control, which is very problematic. But there's so many bombs coming off. The inflation environment is so bad that you're going to have some sort of reset. And I do believe they're going to use a digital currency to try and introduce a universal income and basically control us even more. So, yeah, I don't think the Chinese model is the way to go, but unfortunately, I believe that's where the global elite think we are going.
Yeah, I agree. I mean, that was the other question. Do you think there could be a moass of any kind now, everybody owing all this money in collateral, or do you think there needs to be a CBDC in place before that to happen?
Well, I don't know whether the government would think a moass is a socially beneficial thing. I do think, from our point of view, obviously it is. My thing, like people ask me, do you still believe all-time highs are possible? And it's like honestly, it's an impossible question to ask now because when you construct a scenario for like AMC to squeeze, there were certain, like, you're looking at all the factors, the cost to borrow and how many shares were out there, and the financing costs and all that stuff. And yeah, I do believe there's still a squeeze possible, but like based on what happened with Switzerland, and basically the shareholders of UBS didn't even get a vote. I do believe the government's going to step in and manage a moass in some point. Where it's like, yeah, you guys are capped at $500, and don't forget there was well, I don't even know. I know, like 2 year and a half ago, there were certain YouTubers that were talking about, I have a contact at Morgan Stanley that said the government's going to make a deal. And of course, nothing ever happened. But I do believe that is a possibility, that the government will mandate some sort of set price. And that I don't know, what is the probability, and then what would the price be? I don't know. But I do get that question a lot. It's like, Peter, used to believe this. It's like, yeah, I wouldn't be in the play if I thought this was a lost cause. But I honestly don't know what the price action will look like. I don't know how many people will paper hand at $30. It's like, I'm happy to be out. Some people are talking about $120 right now on Twitter. It's like, yeah, that would be very tempting for a lot of people, I think, at least to get out at their original, entry costs or whatever, cover that and then ride the rest. I don't know how this play looks, and I don't know how GameStop looks at this point. It's just the regulatory environment has changed because the government is being forced to do stuff that is not by the rules. I said FDIC bailing out Silicon Valley Bank was basically tearing up the rule book. So anything's possible at this point.
So the way I see a path to the CBDC that they want to put in place, do you agree? You'll have your Fed now, which will be your instant pay now. So they'll kind of get you warmed up to the digital instant pay. And then after that, there'll be a stimulus of some kind in the form of a CBDC. And then after that, they'll introduce CBDCs. Do you agree?
Highly probable, yeah. I mean, there's a lot of people saying, oh, pay now is not CBDC. No, it's not, but it's a precursor. I mean, it might as well be a precursor. So,
yeah, I see a stimulus coming pretty soon, because right now what I think they're trying to do is crash the economy and then be like, all right, hey, we got to introduce a stimulus, but we'll have to use the digital, type of CBDC pay now type thing that will run on our pay now system, is the way I look at it.
Yeah, no, exactly. It creates it. I said that they need to get this digital dollar accepted. They need to offer a sweetener. Like, there's too many cranky old people that say, I don't trust the government. Well, if you add enough sweetener, some of those cranky people might say, oh, well, okay. And so, yeah, they'll basically bribe the populace into taking it. And they'll say, yeah, don't worry if the government knows exactly what you're spending every dollar on. Don't worry if the government's encouraging you to buy from AMC as opposed to Cinemark. Don't worry about it. I mean, that's it. They could basically make it cheaper to go to a movie at AMC than the other. It's like there's all kinds of insidious things they can do with this thing.
Oh yeah, and then they'll always say, yeah, but it's in the benefit of you guys if you guys don't know how to manage your money. That's what they basically always do. It's your fault you guys don't know how to manage your money, as they're blowing billions and stealing trillions by the day.
Yeah, they could say, oh, we're giving you $100, but if you want to buy stocks, well, you can only buy $20 worth of AMC because we recommend that you really shouldn't do more than that. So yeah, we'll let you buy stocks with that $100, but you got to buy $50 of Apple and you got to buy $10 of Amazon, and then we'll let you buy only $20 of it. It's like they'll force you to. They'll put limits on things. It's like, this is, it's like, oh, smoking is bad. Okay, well, like we've been trying to tax you to death on that. Maybe they'll keep doing that, but it's like, yeah, we only let you buy 1 pack a week. So that's the kind of stuff that's going to happen. Oh, like, for example, for me, I was like Coca-Cola. Well, Peter, you've bought 2 cases of 24 cans in the last month. That's far too much for you. You can't buy any more Coke for another 6 months. That kind of BS is going to happen, I'm sure.
Oh yeah, or the thing I thought they were going to do is be like, when they introduce the stimulus, what they're going to do is all right, if you spend this on food essentials because they're so high, they'll be like, you'll get this special CBDC discount on top of the coupons, and that will be your incentive to use that instead of your cash.
Yeah, absolutely, yeah. It's like, yeah, you get $100 cash, or you get $200 digital currency. Yeah, and exactly stuff like that.
Yeah, so I mean, it's all pretty much predictable. Well, like you said, it's all just about control in the end of the day, and then keeping the ball rolling behind the scenes. And it's like, how many more of these programs can they create and just put trillions and just throw it onto the feds?
Yeah,
Eventually, there's nowhere else to throw it.
Yeah, that's the delicious thing with the debt ceiling. It's like anything that has to happen, the debt ceiling has to be fixed. Unless they decide, debt ceiling is a meaningless law. Like I said, how many laws are you going to toss aside? You already burned the deposit insurance law, and not just for U.S., but basically it encouraged UBS and Switzerland to basically, break the laws there. So like every time you break a law, you've undermined the entire infrastructure. So at some point, the entire thing becomes a joke, and then you'd have to replace it with new laws. But you're going to have a buy-in for those new laws, and so you got to sweeten it, and that's going to be inflationary. And so yeah, it's a big domino effect. Absolutely.
Yeah, and I mean the problem is also you owe 22 trillion out of the 31 trillion to your own people. So it's like you can't just keep throwing this onto your people, and when they go to retire, when they go cash in on their insurance, their 401ks, it's always gone, and they can never retire. Eventually, they're going to go, what the hell?
Yeah.
But that's all I got for you today. Do you want to go over anything else? You got any questions for me, or?
No, I think I'm burned out. I just got a DM from Twisted though. He said he had more to ask. I don't know if you booted him or I don't know if he's still around.
Oh yeah, I let him go after that one. I wanted to get going here too. If you didn't have anything.
Gotcha. Okay. Yeah. No, I'm good. And yeah, as I said, this week will be crazy. And I don't know if I'm available next week, but if check back with me on Thursday and maybe we do another one on next weekend.
Okay. Otherwise, I'm off on Monday, Tuesday. If you want to do another one there too.
Okay, we'll play by ear and see what's.
All right, everybody. Yeah, thanks for coming. I'm gonna get going here though.
I always appreciate it.
Okay, no worries, guys.
I will see you guys. I'm off the next 2 days, so I mean, if it's gonna go nuts, I'll definitely be going live. I think this week's gonna be very interesting. Like I said, you're gonna maybe see Evergrande finally go under. I can't see a domino effect not happening. You could definitely see a domino effect coming soon. So, like I said, guys, get your popcorn ready. It's gonna be a very interesting week. Thank you guys. Have a good day.